Hello and welcome to today's KraneShares webinar, Innovation in Hedged Equity, KSPY. My name is Brendan Ahern. I'm the Chief Investment Officer of KraneShares Exchange Traded Funds. I'm here at Hedgeye Risk Management's headquarters, joined by founder and CEO Keith McCull, as well as the CIO of Hedgeye Asset Management, John McNamara. I can't think of a better time to be talking about what's happening in terms of global markets, risk management, than what's happening today in general. Washington, D.C., the economy, you name it. I think as I embark on my 7th trip year to date outside of the United States,
Wow.
a lot of the feedback I'm getting from investors, and if it's in Europe, if it's in Asia, a lot of concern about U.S. economy, U.S. stocks, political stability of the United States. Are we jeopardizing the reserve dollar status? 17 trillion of foreign capital invested in U.S. equities. Is a global rebalancing happening out? Just a lot going on, and I think there's never been a better time for a risk-managed approach to being long U.S. equities with all of these factors going on, which is exactly why we launched the KraneShares Hedgeye Risk Managed S&P 500 ETF, ticker KSPY. For those joining us online, please email us all questions to info@kraneshares.com. We want to put John and Keith to work, as well as if you are a SEMA or CFP, you can garner an hour of continuing education credits. Please email us your license number at, email is ce@kraneshares.com. But let's dive right in, Keith. You founded Hedgeye Risk Management. I think the key being risk is in the title of the firm.
Yeah.
And then and I spoke about some of the concerns I'm hearing from foreign investors. A little bit less so, I think, here in the U.S. I think there's some have called it hubris, ego, or just, maybe we're just after 15 years of just U.S. markets going straight up, everything else non-U.S. going down. I think there's maybe some level of complacency. Maybe it's people like me who've been in the ETF industry, 24 years now. I'm sitting on some real big capital gains. I hate paying taxes. But yet, I think one of the reasons my new U.S. equity is going into KSPY, because I don't want to pay taxes. I hate taxes. But for new allocations, I'm putting that into KSPY because I am concerned about some of the things out there, and just kind of curious, what you're seeing. Maybe for those less familiar with Hedgeye, I think you've got such an interesting background and the thesis for finding this firm, for creating this firm, and that's a great segue into John's work at Hedgeye Asset Management.
Yeah, it's I'd add to your laundry list of reasons why people are complacent and or otherwise. It's a compensation scheme. If you're paid to only market and promote U.S. equities and they've performed, well, you just keep doing that. Right. There's no alternative strategy to that. Last I checked, I don't think you can reinvent yourself as a global macro strategist if all you do is levered long SPY. Interestingly, maybe Gendron on our side has the chart this morning from Tier 1 Alpha. They showed the growth of levered ETFs. So as you know, it's not just ETFs, U.S. growth ETFs that you want to be long, it's levered.
Right.
So we're the opposite of that. We're risk managing leverage, and really you don't have to look any further than the stock market crash of 2025 that we've already had to see the efficacy or the results associated with not drawing down or crashing in SPY itself. So again, that was north of a 20% collapse. Now it was short term, it doesn't mean you're in a bear market. I'll get into it maybe if I give a macro update, because what we call quad 4 market event, when the stocks that everybody owns, the 7 stocks, which are 30% of the S&P 500, that's of course that's quad 4 as we call it, quad 4 event risk, but it doesn't have to be synonymous with a recession. So we fit, on that. If I was a fly on the wall, I have been. Mexico City, Bahamas, and going to Ireland tomorrow. You do hear that quite a bit. I mean, it's like, especially if you're not an American.
Yeah.
Which I, identifiably am not. I have an American firm, I'm married to an American woman, you know her very well. I have American kids, love America, right? But I don't love it in the sense that I go tell everybody else in the world to go, that we're exceptional and they're not. Some people might take that a little differently. That's not a political comment, it's what actually happened to global macro markets.
Yeah.
We're long Germany, we're long Mexico, who would have thought?
Yeah.
We're long Poland?
What about poor Pierre?
Poor
Pierre. I mean, the guy thought he was going to be be running Canada until Trump came along, and now you got Carney, right?
Yeah, we're not long Canada. We're long Australia. We're long a lot of different things. But that's actually been, and I'll get into that as well, one of what generally happens in macro, especially if people have absolutely no market experience, never mind accurate market experience across cycles, like you and I have been doing it for a quarter century combined, almost half a century. It's that they take their political thoughts, their feelings, their biases, and they superimpose it into what the market could or should do, right? We do what markets are doing and what the data is doing because the markets are front running the data that's coming.
Yeah.
So that's that's how we really make the sausage here, and that's how I end up with all these different asset allocations, which are pretty much opposite of what they were if we were standing here back at the beginning of February. So it's a really interesting time. But again, hedging U.S. equity market risk is. I mean, I'm not shocked that there aren't a lot of competing products for that. There are buffers, which I'm sure we'll get into. Buffers. It's kind of like bumpers on bowling. Not what we do. No. So what we do, like, if you want me to, do you want me to get into kind of the outlook?
Yeah. I think it's great. I mean, I think it's as subscribers to your research, we take a lot of value in understanding how much work goes into the process and how you think about the world. And I think that really is encapsulated in our partnership product, KSPY, which John runs. But I think understanding those inputs to the sausage are really important.
Yeah, I mean the most important thing, guys, if you pop it on the slide 5 from a methodology perspective, is looking at the world, Brendan, in rate of change terms. So for those of you that aren't mathematically oriented, I think most of you probably know what a sine curve is. That's what that is on the right. So things are either accelerating or decelerating, just like your car or your bike or your feet. You're either going faster or going slower. So again, that's all we care about. We don't talk about whether the car is good or the car is bad. We don't talk whether the car is either accelerating or decelerating. Accelerating is good and decelerating is bad. And we look at both growth and inflation in a 2x2 model that way, which summarily gets us to the next slide, which is what we call the quads. Okay, the quads are quads 1, 2, 3, and 4. Quads 1 and 2 are accelerating growth. Quads 3 and 4 are decelerating growth, with quad 4 being the nasty, where you decelerate at a faster rate because growth and inflation are decelerating at a faster rate. So you can't even be long things that, like commodities or anything, that would be recipients of inflation, right? So quad 4 is terrible for a lot of things. It's very good for hedges, puts, and having, for example, an S&P 500 hedge strategy. So that's where we were. That's what the model said was going to happen. Looking backwards is always very easy. This one we got correct. We were actually in quad 2 from October until January. So again, no matter what your political affiliation, I could have told you a raccoon or a clown was going to win, or both. Maybe that's what happened both times we've had elections. Or somebody who's, it doesn't matter, somebody who's asleep, weekend at Bernie's. I would still say the same thing, right? It has nothing to do with being a Republican or a Democrat. I am a Canadian, okay? And I wouldn't vote for any of those parties either. So again, what I vote for is, again, the rate of change of the data. And the data accelerated from October to January, decelerated from February to the month of April. That's where markets, not ironically, bottomed, equity markets, U.S. stock market primarily. There are other markets that all the while, like I just said, just kept going up. I mean, we just continued to see new cycle and all-time highs in a lot of different places. And that was a real important message for those of you that are diversified, because you should be. But now if you look at what we call the monthly quads, what we have is coming into going back to a quad 2. So that's slide 27 there. Now this is our our own proprietary data and models, of course. They're modeled in real time. So again, what we have is this spike back to quad 2 in June, and the market's been very good at front running that. What we typically find is the market's front running the next month by 2 to 4 weeks. And again, the nasty's coming back in July. Now, that's another career now away from me in this market, because this market, is another topic I'm sure people want to get into. The market's never been more levered in terms of short-term options. The market structure being the U.S. equity market structure, 0 days to expiration trading. You can show that chart maybe if you have it, Gendron. A couple days ago, 70% of U.S. equity options volume was expiring on that day. Okay, 0 days, weeklies, et cetera. We've turned this into a certified casino with leverage. Okay, you can go to Robinhood and trade for free options, right? That actually equates to half of daily options flow. Sometimes is the retail investor. I'm sure that'll end really well, but it didn't in April. That's not what happened. So again, what we would expect is that you're going to see more volatility at a bare minimum, which you can trade both bullishly and bearishly. Currently, we're trading that bullishly. Into the quad 2, and then we're going to change again. And some people might say, well, that's a little too fast for me, and I say, well, that's a little too bad for you, right? Because that's what's happening. I mean, why would one tune into what the market is doing every day if they don't want to act on it? Like, why? If you don't want to pay attention, then just stay in your basement. Don't ever buy an umbrella. You don't have to go outside. You don't have to worry about rain ever, okay? But that's not what we do. Like, what we do is actually happens in real life. Your largest assets, I know where Brendan lives, unfortunately for him, but I know where he lives.
Time to move.
But would you ever not have home insurance or car insurance?
Of course not.
These are kind of big purchases.
Yeah.
But I would bet that, you have a very nice house, but I bet that your retirement account is bigger and more valuable than your house.
Yeah.
Yeah. For a lot of people, it's a lot more valuable. Why wouldn't you buy insurance on that? Oh no, you don't want to do that. You just want to own stocks. Yeah. You just want to be no insurance.
Yeah, and actually, U.S. stocks are actually larger than household wealth in the U.S. I think it just happened for the first time.
Why would anybody ever want to insure that?
Yeah.
And by the way, if you understand that you could insure it buying puts, that's rendered itself pretty much useless too because of the 0 days to expiration structure that the market has become. Like, most hedge funds really suck in down markets because they can no longer hedge past their nose. They have to start hedging like for today. Tomorrow's Saturday, so that would be a bad example, but you get the point. And it's that's what we're really paying attention to here. A couple other points that I would highlight just in terms of our outlook. While we were the only firm that went from bullish in January to bearish. Okay, there are a lot of people that have been bearish the whole time, right? Political types. We're in a recession. I'm a Democrat, I hate Trump, blah, 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 right? And then we saw recessionary expectations peak in April at the bottom, right? That's very typical of Wall Street. Well, none of us called this risk, but we all now understand it, and we're all calling for a recession, so we're going to all lose together. That's very typical of Wall Street, right? Like, they've only missed every single stock market crash that we've called, and it sounds like, to some people it sounds cocky, but we have called since 2008 every U.S. stock market crash, and there have been many of them. In Q4 of 2018, the U.S. stock market went down over 20%. We called that too. And please, if you're new, if it sounds cocky, it's not it's confident Keith, not cocky Keith. Okay? But it's something that we do. So you need somebody to risk manage the bloody thing, and all the way, what tends to happen, so what I was going to say about this, if you look at, guys, our current GDP nowcast, which I believe is on slide 22. So we called for a big GDP slowdown. That's what quad 4 is. We were actually within 2 basis points of the negative 0.3% number there. So GDP did go to negative in the first quarter. That's not fake news. What was fake news is that there was going to be a recession imminently in Q2 and then Q3, which is a lot about the discussions that you have with people, which wasn't an inconsequential discussion. It could have happened, but it wasn't happening in the data. What you find is actually the hard data in the U.S. has actually been pretty stable, to in some cases actually accelerating because you're pulling forward tariff expectations. So it's a whole other kettle of fish of behavior out there. But we have a GDP number that was once the high on the street up until like 2 weeks ago. Stock market rallies, everybody takes their growth estimates back up, but still worries about it's a recession, right? So really, if you look at the process in motion, okay, now we don't have a recession and we have a quad 2 coming, so let's get long. So that's how we did it. And it doesn't really matter what people think about the reasoning behind that. It's all math and rules based. On inflation, if you flip ahead to the year-over-year nowcast on inflation on the next slide, I think it's on slide 23. So growth and inflation is what we're trying to solve for. What's interesting about this is that, yes, we have inflation just bottomed in the most recent month and it's set to reaccelerate, but it's not reaccelerating towards the Wall Street narrative that tariffs are bad, it's going to be the next 8 or 9% inflation, which they didn't call on that chart if you go all the way back to the left side. We did, right? Because we have a nowcasting model. So we risk, just like the weather, right? If you want to risk manage weather may be a bad example because you don't like the weatherman. They're wrong a lot, right? Well, we're more right than the weatherman, which is a pretty low bar. But the whole point here is that we're constantly nowcasting it. The number one reason why inflation is not going to go up as much as those yellow bars, if I was as bullish as I used to be on gold, I call them gold bars. But I'm very bullish on the fact that Wall Street gets it wrong a lot of the time on growth and inflation. They thought it was going to be a recession. It's not going to be a recession. Back at the beginning of that chart, they thought inflation was going to be transitory and ended up doubling twice. Now it's going to go up marginally, slowly. At some point, it could go up all at once due to tariffs, but not anytime soon. And I think that's another pretty important takeaway on why, how bullish would you be right now? And again, you can be bullish on the S&P 500, but also trade it. Mm-hmm. And we can get into that. Our process on hedging the S&P 500 is just that. So I do think, if I just look at our market outlook from here, it's this range-bound S&P 500 that's no longer in crash mode. It's got 2, 3, 4% upside. Currently, the upside, to be very specific, was 1.7%. Okay, that's what we call the top end of the range for the S&P. It's a lower high versus the all-time high of 61.44. So again, that tells me that we're going to be bullish bias, range bound, with a lot of what we call chop. So the chop bucket, we have a nice icon for that. The chop bucket is when the VIX, which many of you know about, the VIX trades between 19 and essentially 29. If you're beyond 29, which we went to over that period of quad 4, where the VIX went to 52, we put an F in front of that bucket. And it's a very, very bad word that a very polite Canadian would not say. I don't know if you heard this morning on the call, but we announced formally that the real reason why Trump wants us Canadians to be the 51st state is because we sound smarter and we're funnier, okay? And you would want that as a factor exposure.
A lot of Canadian musicians as well. I mean, you're not a singer that I'm aware of, Keith, but there's been Canada's produced hockey players and a lot of good bands.
Gordon Lightfoot, have you heard of him?
Yeah.
How about Rush?
Old Geddy Lee. Great bass player.
So that, for us, we're just we're looking at this for what it is.
Yeah.
If you think something's range bound, you want to sell high at the top end of the range, and you want to buy low at the low end of the range. What's very interesting about this dynamic is you go from this everything's fine to the world's going to end,
right,
to back to now they don't know what to do, and that's actually a good thing to know, is that it doesn't have to do anything. Because people typically try to make somethingness out of what happened in the rear view, and it could actually be nothingness. In other words, a range-bound market, the downside in our S&P range is around 2.5% below the market. So that's really tight.
Yeah.
I mean, and I like that. Yeah. I like being in the chop bucket.
Right. Well, I think ultimately the key is that you have this process that you've refined over decades, and we can't predict the future. The economic and market inputs are dynamic; they're changing. But you did a great job articulating how the biases we have. If I'm a long-only manager or advisor, I've got a bias, and I guess even for myself, like I've spoken to some of these big foreign investors who they're imparting their own biases on their asset allocation.
Yeah.
What time will tell who's right, who's wrong, but ultimately, one of the things we've seen at KraneShares is the growth in these buffered ETFs, and I think this is a product that is very basic in design, but certainly we've seen it grow exponentially. On slide 3 of the KraneShares deck, I'm sorry, it's slide 5, is the growth of these structured outcome ETFs, which again, I think people are investing in these funds for a reason, that they're worried about the economy, the market, what have you. But I think part of our issue, which Cliff Asness, who's just down the road from here on the next slide, of AQR Capital Management, a very well-known quantitative asset manager, has spoken about, like, the problem with these funds is that you're really not getting what you think you're getting, and part of that is just because when you buy them, they've already locked in a certain level of insurance. And kind of, Keith, you're meant to talk about, like, would you ever own a house without insurance or car? I think the problem is more of a lot of these buffered funds. It's almost like buying insurance when your house is already on fire. That this elevated VIX level, if you're buying and the VIX is at 30, 40, 50, as that market dynamic shifts away and VIX starts to fall, it's eroding the value of those options. And so that's where we think it's like, we like the idea, but really I think that's what's led to our collaboration. And John, I think one of the as the portfolio manager of KSPY, you're taking all of Keith's and the research team's inputs, but you're trying to avoid one of these inherent problems that I think is embedded in these buffered products. And I was looking, I was just looking at the performance of some of these products versus KSPY with billions of dollars, and they're just not fulfilling what I think people thought they were buying. And I think that's, we think we self-serving and highly biased. We think we have a better way based on the process that you're embedding within KSPY.
Yeah, and frankly, the massive growth in the space, both the hedged equity space, but also the buffered space is frankly, part of the reason that we launched this product was, my background is in derivatives trading. I became aware of these funds because of these massive derivatives trades that were hitting the tape on sometimes an annual, sometimes a quarterly basis, and started doing a bit of digging into these products and saw that they had tremendous AUM and have had tremendous AUM growth. Wow, these must be really sophisticated vehicles. Pulled back the layers and came away very unimpressed, and kind of looked at what we had in terms of these risk ranges, which Keith obviously just reviewed briefly, and said, surely we can produce something that is better than this, and I think we have done that with the Hedgeye Hedged Equity Index. Taking a step back, I know Keith went through the quads and then also to some degree the signals, but the way that I like to think about kind of Hedgeye's outputs, which from my perspective on the macro side is the quads, which is kind of your map, your paper map, and then you have your price signals, which is obviously the input to this strategy, is your your Waze, your navigation. So you're going to follow the map on where to go, but your navigation is going to be telling you, hey, go this road rather than this road, and that's kind of what gets us to our positions in the market, and our positions in the Hedgeye Hedged Equity Index. So yeah, taking a quick dive into the strategies, a quick overview. Eric, if you go to slide 13 on our deck. So the Hedgeye Hedged Equity Index, which is licensed to KraneShares for use in their ETF, is basically the goal is to provide exposure to the S&P 500 while providing downside risk management and volatility reduction. And the way that we do that is basically through the utilization of the risk range signals. If you push ahead to slide 15, basically the strategy is unique in three aspects from my perspective. First and foremost, obviously in the utilization of those risk range signals. Secondly, is in the utilization of these three unique option strategies. And third and finally is that the strategy is completely systematic in that it's index-based. So, basically the way that we differentiate ourselves versus the incumbent players in the space, which as Brendan alluded to, have a tremendous amount of AUM, is, by the utilization of these three option strategies, which are based on the risk range signals. So, the incumbent players in the space, whether it be the buffers or the hedged equity players, they deploy what's referred to as a put spread collar. So they're selling a call to buy a put spread. They do that on either an annual or a quarterly basis, and that basically sets up the quote unquote hedging in their product. We also deploy that strategy. However, we only deploy it when the S&P 500 is within the daily published risk range. So, basically we're selling a call at the sell risk range, selling a put at the buy risk range, and buying a put at the last price of the S&P 500. And based on Keith's duration of 3 weeks or less, we target options that are 3 weeks out in expiration. And rotate between these option strategies anytime that risk range regime changes. So where the strategy starts to get really differentiated versus the incumbent players is in those above and below risk range regimes, which as Keith I'm sure will speak to shortly, are very high conviction environments. As a matter of fact, since Hedgeye started publishing the S&P 500 risk range in 2015, the S&P 500 has closed within its daily published risk range 83% of the time. So, at least speaking to some degree of the efficacy of the risk range signals, those above and below regimes are very high conviction. So, basically when we're in the above risk range regime, we're expecting to see an immediate term pullback in the price of the S&P 500. As such, we basically write an at-the-money call and buy an at-the-money put, which is getting the delta-adjusted net exposure of the portfolio down towards zero. On the flip side, in the below-risk range regime, we're expecting to see an increase in the immediate term price of the S&P 500, and as such, want to maximize our market participation. So in that environment, we still deploy a put spread, given we do want to have a level of hedging in the strategy. As Keith would say, markets often do crash from oversold levels. However, we do not sell a call. So, General, if you flip ahead to the next slide, basically you can see, the strategy is really dynamic and, has an ability to, not maintain a constant level of exposure to markets like the incumbent products do, and, has an ability to be really dynamic, and based on what I think Keith would describe as, hedge fund quality backing in the form of the risk ranges, which obviously, he developed during his time as a hedge fund manager, to be a quantitative risk management framework to augment his fundamental views. So, that's how the strategy works. Like I said, we are really targeting and going after, this boom in buffers, if you will, which, I was down in South Florida recently and having, dialogues with clients down there who, this really resonated with because, from their perspective, these buffers are great because, they allow clients to have, a level of market participation. But, at the end of the day, these clients are much more worried about capital preservation rather than, triple levered NVIDIA or, whatever have you.
Yeah,
So.
well, I think also you're able to maintain that exposure, right? That the market goes up more than it goes down, right? This is kind of the Morgan Housel, just buy and walk away. But that's I think A has a significant U.S. bias, really driven from the last 15 years. If we were a Japanese investor in 1989. That strategy of buy and hold did not work. That right, these regime changes. But I think you maintain the exposure, right? So you're long U.S. equities if things turn out great. But we have this embedded hedge, and I think one of the things that shocked me is that there's a fund out there with billions of dollars that makes market timing calls. and they went to cash, basically at the market low around Liberation, following Liberation Day, and have stayed in cash. So they totally, market came down, came back, obviously ripped back. KSPY, mitigated some of that volatility. Obviously came down a bit, but then participated on the way up. Like, we're not making this black and white, in the market, out the market call like this market timing fund, which, again, billions of dollars, and the market's done nothing but rip higher, and this fund sitting in a money market fund.
But what I love about you're just depicting the reality of it all that way is that, it's nice to say, and it is true to say, that markets go up more than they go down. But that's the average of all time. In recent times, we should be old enough to remember 2020, 2022, 2025, when the S&P 500 crashed all 3 of those years. Okay? That's not even going back to 2008 on the big crash call we made, or in 2018 for that matter. So, and what you find is, if you go back to 2016 too, oh wow, the stock market actually crashes every 2 to 3 years. Given the current market structure, dynamics, levered participation of players, and manifestation of over 3,000 ETFs, largely levered too. So it's a better thing to say, in all respect to Morgan Housel, is the market's doing what it's doing today, and that's it.
Yeah.
And then say it again tomorrow. Oh, the market's doing what it's doing today. Yet our view isn't what the market needs to do because of what it did. Actually, if for those of you that are mathematically inclined or have studied stats or anything like that, that's called being a frequentist in probability theory. All I'm doing is telling you, like a baseball stats guy, what the batting averages were, anything that happened in the rear view. That's a job, right? But being a good Bayesian boy like me and McNamara would mean that you model things stochastically. You take incoming data and your position changes accordingly. It isn't based on the average of the past. So it embraces today. And I wish, in my heart of hearts, when I'm long gone from this world, I hope that our kids start with, don't lose money. That's rule number 1. Rule number 2, embrace uncertainty, because you have no idea which direction the market's going. You may need it to go a certain direction, or want it to go up more than it goes down. Or in my case, you may need or want it to crash. Some people think I want that. No, right? And just go on with a different starting point. Because even with the hedge, what you just said about these hedged buffer things or bumper bowling thing, and the house on fire, I mean, it's 100% consistent with what Wall Street does.
Yeah.
Right? They're going to overpay for insurance at the bottom of a market move, and they're not going to want insurance when they need it. So that's at least consistent. Their version of what is hedged is consistent with how they think about it, which is upside down.
Yeah, and look, I think, as I said, when kind of we were thinking about, doing this, and, taking a look at, kind of the strategies that are out there with many billions of dollars, you do come to find out that, basically they're just, deploying options that are, X% out of the money based on, predetermined averages of data over long periods of time. What I think is so compelling about our strategy is, as you said, these risk ranges are taking in what's going on in markets and adapting and being produced as such.
Yep.
So it's a much more dynamic and intelligent framework to deploy this strategy that's obviously become very popular with investors. So.
The idea of hedging has become popular, but so is the idea of driving a Formula One car. I mean, that's quite an idea. Now, once I get in the car, what do I do? Right? Oh, I want to be hedged. Okay, go. What are you going to do with that?
Right.
Bumper bowlers? Like bowling with bumpers? I don't know. That's not how we drive the Formula One cars.
Yeah.
Right, and that's the beauty of the product with KraneShares is that we have delivered something that takes into account these risk range signals that come out of Hedgeye, which are a legitimate vetted hedge fund level product in their own right, and we're delivering this this vehicle for folks to invest in that basically does a lot of the work for them that would be very time consuming.
Yeah,
for them to do
I mean, this is the
otherwise.
great.
So.
I mean, I guess I got to be a little careful, where. I wanted to call this the broken buffer, but we weren't allowed to put that in the title. But
Bowling, we're calling it bowling.
bowling, okay. But I think that's this. I mean, I just think about myself. Like, right, I got a day job. I'm doing my thing. And I'm putting you two gentlemen to work every day, at a pretty good fee, at a nice little fee, that I'm able to sleep at night knowing that, if things go well, I'm gonna participate.
Yeah.
If things don't go well, I can sleep fine. And I think that's that. That I just think of. I think there's a lot of investors out there, that level of complacency. People are sitting on big gains after a huge run up, and yet we need to stay invested in equities just because of inflation. But how do we do so in just a risk controlled way? And I'm such a believer in the fund. It kind of beats me up a little bit that I know we're getting more interest, things are growing, and we got to build that track record. We're coming up on the 1-year anniversary, and I think the fund has fulfilled what we set it out to do. And hopefully, as we clear some of these kind of institutional milestones, we'll get more further due diligence inquiries, which is happening. It's just we kind of understand. Particularly for non-Hedgeye subscribers, you got to kind of understand what's going on here and how that process is embedded in the product.
Right.
So I'm really constructive on the fund, and I think ultimately a lot of these issues that are concerned about that, again, going out and meeting with foreign investors, I don't see those issues going away. But at the same time, if you acted on those fears in early April. Man, it's just you got smoke. I mean, and how do you make up for that? It's going to be really hard.
Yeah. Our institutional subscribers. I mean, it's one thing to get. For us, it's Hedgeye Asset Management, or what we call HAM internally. John is the leader of the HAM. Right? There's Hedgeye and there's the HAM. But for us, it's kind of an interesting position because we launched asset management 18 years into building Hedgeye, not the other way around. What we wanted to do is establish the credibility of the process. Like, again, we don't have a broker-dealer, we don't have a bank, we don't make any money doing anything other than selling independent research, and the accuracy of these signals, and the accuracy combining the signals with the quads is what people pay us for. Okay? If I rattled off the list of our clients, you'd be like, pretty good. Guess what? We had to validate the product with the best and I define best not by who's got the nicest hair, or whatever. It's or who sounds the best. It's performance. Okay, so for 17 going on 18 years, that's been our exercise. I mean, just to put it in context, what's embedded in KSPY is in my data. If I do not have the daily risk ranges in the hands of the biggest institutional investors in the world every single day, I'm going to probably eventually get fired. It's part of their process. And in a lot of ways, it can be, I wouldn't say self-perpetuating. When something establishes itself institutionally, like our quad process, our real-time nowcast for growth and inflation, nobody's been more accurate on either as of late in particular. And those signals, then when more and more people follow the same thing, then it actually has more action around those actionable levels. So that when I say self-perpetuating, there's a little bit of that, I would say. Some might argue, some clients say there's a lot of that, but whatever. It's just the thing. It took a long time. So this is not a startup, even though like our asset management products are new.
Well, and to that end, Keith obviously has been utilizing the risk range signals in his process for much longer than Hedgeye has been publishing them, but we do have published data on those risk ranges, as I said before, back to 2015. And as such, we have index data on the product, although it's very new, back to 2015. And I think you can request that on a reverse inquiry basis. But basically, you would see that during those periods of intense volatility, large drawdowns, the strategy has been able to deliver. So.
Yeah, and certainly we've got a new white paper coming out over the next day or two that looks really delves into some of these issues with these buffered ETFs. So if you like the white paper, even today's presentation, you can email us at info@KraneShares.com. We can get that to you. For institutional investors, we are able to provide some of the historical data of the risk ranges. Unfortunately, just for compliance reasons, we can't give it to individuals. And again, if you have any questions for Keith and John, please email us at info@KraneShares. We've got a few that we'll tackle. But again, I think ultimately, Keith, what are the things that are maybe out there that you're thinking about? What are the things that kind of maybe are hitting your radar screen in terms of market dynamics or economic data? I mean, one of the things that I saw, I write this little my research note. China last night, that in China there was a financial media about within the House bill, the U.S. House bill on President Trump's budget bill, that there's potentially a tax applied to countries that discriminate against U.S. companies, that they're going to put a tax on investors from those countries. Starts at 5%, increases 5% a year to a max of 20%. So these people in China, people were talking about like, oh my gosh, like we own all these U.S. treasuries. If we're one of these countries, that it's up to the Treasury Secretary, is what apparently passed the House bill. It hasn't gone to the Senate yet. Actually geared more to Canada, Europe, Australia, that have some taxes on U.S. tech companies. But I just thought it was so interesting, that something that I've not seen or read about, and digging around, I guess Bloomberg did an article yesterday, Reuters has an article today about this. I think it's Article 866 in this big, beautiful bill. Has people in China really worried about their U.S. treasuries? It's mainly income and dividends. I didn't see anything about capital gains, but it's very, this was something that kind of just, I was like, wow, like this, for non-U.S. investors, the S&P is still negative because the dollar's declined versus a lot of the major currencies out there. So just the dollar's weakness, even with the S&P 500 rebound, it's putting a lot of pressure maybe on some of those foreign investors holding U.S. dollars. Something like this potential tax, could really, the real concern was about the U.S. Treasury holdings. Just, in order to fund, we need these foreign investors to participate in Treasury auctions. This would be a huge disincentive. But anyway, it's something that we'll see if the Senate version contains this or not. But just something that I think I kind of stumbled upon. But anything kind of similar that's out there on just potential positives, could be good news, could be.
Yeah, I like, as I said at the outset, I think that for now, the trade it's better than you think if you think it's really bad, right? It was bad. I'm talking about the U.S. And in many parts of the world, it's actually a lot better. So depending on what your asset allocation is, like we should know that gold's up almost up 28% this year. Right? And that's a lot. So having a different view on asset allocation, diversifying across asset classes, across countries. Stocks in the U.S. are a uniquely American bubble, as I call it, the mother of all bubbles. If they weren't, they wouldn't have gone up. Yeah. And in a lot of cases, I think what a lot of people fight is just that dynamic. Is it like, oh, it's a bubble, so I can't buy it? And it's like, no, because it's a bubble, it goes up, so you should buy it after it goes down. That's how you think about the bubble, right? If you want to try it at home, you just take a big ball and go in the pool and you put it underneath yourself. If you're heavy like me, you just thing pops right back up. So it's not that hard to understand. It's harder to execute on, and some of the things I think what you said, we can have. When I say embrace the uncertainty, I fully expect every single day not to have any idea what they're going to do next, and or what the market reaction is going to be. but I do know what my process is to incorporate all of it. And that's the most important thing. I think the biggest, like if you guys go to, I think it's slide in our deck, slide 60 or 61, the biggest structural issue that tariffs are going to impose on the U.S. economy away from markets is actually into corporate margins. So when you look at where corporate margins were pre-tariff, okay, actually if you go to the slide before it, it's a bigger chart that can help people. This is the U.S., just take the U.S. aggregate corporate profit margin at an all-time high. This is pre-tariffs. If you go back to a world in America where tariffs were actually a thing, I should say, weren't not a thing, the 1970s and 80s, you'll see not only much lower margins, but huge cyclicality, right? Like it goes up and it goes down. So you're coming off the all-time high. What could possibly go wrong? Like what we do know about tariffs is that it's negative for margins. So if you go to the next slide, what you also know for stocks, is that on the right side is just a zoomed-in version of that. Going into 2021, which is when we were ragingly bullish on SPY or U.S. stocks, margins were about to expand to the all-time highs, right? That gave you the highest multiple in U.S. stock market history. That's what drives multiples. As I always say, it's not the valuation of things or the simple moving monkey average of things. Yeah, I put that in there. It's actually the rate of change of things. So if the economy is accelerating in quad 2, like in 2021, or right now for that matter, if the economy is accelerating, Hedgeye is going to be bullish on beta or higher beta stocks, including Qs at this point. Much prefer Qs and SPYs here. We'd hedge the SPY, right? But that notwithstanding, like we just saw a double peak right before tariffs got announced. And in fact, it was actually a higher level than 2021. So that would be the biggest obvious risk, is that, yeah, earnings are fine until we actually know what these things mean. And to your point, like, it took a couple days even for the media to pick up on this in a oversupplied clickbait world. That's pretty underwhelming, right? I mean, all I have to do is cut and paste out of things that are actually there, and it took them a couple days, But there's going to be a lot of stuff. And you don't know what it's going to be other than negative for margins. So, the basic example, you travel a lot. I was just in Mexico City, and everyone agreed to one thing. I am currently taking the costs, like these are CEOs of companies, and not what I do, like actual industrial companies, jewelry making company, one in particular. And he's like, well, I'm taking higher input costs. I'm paying them, like 10% or whatever it is. And then I'm just passing it on to the customer, and they don't push back yet, right? Okay.
Yeah.
Well, what happens after that? So this is gonna take a long time to play out, and I think again it just comes back to the same answer. Like, what do you do when somebody's talking about markets, or even like just listening to me rant for the last 2 minutes, God forbid? What are you gonna do with it? Is the question. What are you gonna do in your account? What are you going to tell God help you if you still have an old wall broker, but if you have to call them and tell them what to do still. Notice how that works. People made a lot of money in this world often call the broker, and the broker has no idea. And the broker's like, well, you shouldn't be in so much cash. And and the wealthy person says, well, I'm getting 4.3% in my cash, and Hedgeye says the market's going to go down 20%, so maybe that would be a good idea. He's like, well, nobody else is doing that. And he's like, exactly. So it's like we are in this world where I think that the answer in terms of how you implement it is to risk manage the volatility. It's going to be choppy. In other words, it's going to be volatile. And if you don't have a strategy to risk manage that, then you're just you think you know what to do, but I don't think you do.
Yeah. I mean, it's kind of an interesting point you bring up, and that's where I love these conversations. I get to tap into your brain for an hour on behalf of our investors. But that I think that's an interesting where I was. Reuters did a piece today about Walmart is really leaning on their suppliers. So huge bulk buying, and they can kind of stick it to their counterparties because what other choice do they have, right? Yeah. But that small business owner doesn't necessarily have that same level of leverage on their supply chain, and how does that dynamic play out for the economy that you could maybe see, yeah, Walmart, maybe the profit margins come down a little bit, and Home Depot or whatever. But for the broader economy, that these mom and pop retail stores, which are huge employers here in the U.S., they've got potentially a real problem because they can't aggregate themselves up. I mean, maybe they have some sort of trade association they're a member of, but they can't lobby the White House and get a one-on-one, and then B, they don't necessarily have that. I mean, do you kind of think about how that maybe the stock market is doing, could actually outperform the economy?
That could absolutely happen because the big get bigger and they take share.
Right.
I mean, the whole like back to the whole kettle of fish. I mean, guys, go to slide 1 just to put it in context, where we show really if you go back 125 years, slide 136. This isn't quite like all time, but it's definitely a long time. And to put this in context, like all tariffs did, Brennan, was go down. Right? There was a point in time in America's history, obviously in different centuries, where it was like more than half of U.S. government revenues. Now and then it got bled out to as low as you can go, and then what we call a point of entropy is on the far right side of the chart, where something just does something entirely different, and actually takes out 125 years of history. So what could possibly go wrong? I mean, a lot. And it's going to be ongoing, and it's going to be confusing, for many, including markets, especially if you're chasing. If you're buying protection when your house is on fire on April the 8th, you don't know what you're doing.
Yeah.
Right? A clean-cut signal of somebody who has no idea what they're doing is that they panic. Right? Somebody who actually knows what they're doing, you will not see them panic. Mm-hmm. Like, God help us if our bravest, when they're in the thick of it, in battle, panic. Right? They know exactly what they're doing. Yeah. So and there are a lot of professionals that absolutely do. And I haven't had one performing long-time client that's performed in both up and down markets that would disagree with what I just said. It's like embrace uncertainty. We don't know what's going to happen next. What we do know is that point of entropy is going to absolutely impact margins negatively. Mm-hmm. And it's just on to the next day, whatever we have to deal with.
Right. Just got to roll with it. Yeah. So. And how have you seen, John, day to day within the KSPY implementing this option overlay? How has that changed? Because to Keith's point, we've had a very dynamic market this year to date. We've had highs and lows and back again. But how have you seen, when you distill the Hedgeye research signal into that option, how has that kind of changed over the course of this year?
I mean, I would say, generally if you had to boil everything down to, to one thing, which obviously we would never do, looking at, kind of where the VIX is or where volatility is, whether it be realized or implied, that generally is the driver of kind of, points of differentiation for the strategy. And obviously, as Keith showed to with the chop bucket, symbol earlier that they had, basically this year being in the chop bucket, has been quite beneficial, for the strategy's implementation. And, I think if you look back over time, you'll see that in periods of, elevated volatility, which, by definition is the chop bucket, the strategy is able to really stand out, particularly versus, kind of the subset of incumbent players, whether it be, buffers or, hedged equity. And, the real reason around that is just the ability to be dynamic in those particular moments rather than, it's the particular that matters rather than the average. So, I think that is the real standout differentiating point for the strategy versus the incumbent players, and what's really made a difference this year. So
to use the we haven't really used this house on fire analogy with bowling, right? There's always a different way to try to explain the same thing for Hedgeye. Mm-hmm. Right? It's just math, okay? Right. Now our goal is to help communicate, what this math is actually telling you. But if you just look at a market that after it collapses, recovers and goes sideways, Just think of it like, which I hope it never happens, but you live in a neighborhood where episodically, but on a non-trending basis, your neighbor's houses light on fire, right? And everyone's trading insurance. And as soon as your neighbor's house is on fire, you can sell them your insurance. Yeah. So when the market's at the low end of its range, we do the opposite of the person whose house is on fire, okay? And then all of a sudden, we own like the cheapest insurance in the neighborhood so that when our house goes on fire, it's not as bad, right? The dog survives.
Right.
I love my dog.
Boomer.
Is that a fair way to talk about it?
Yeah. I agree. It's kind of, I randomly was listening to a podcast recently, and it was one of the original card readers. Vegas's. I forget the gentleman's name. He was
Card counter?
Card counter was a professor from
It's a real
University
thing.
of New
I
Mexico.
do it. Yeah, it worked.
And had a great, but what was interesting, he was actually a very early investor in Berkshire Hathaway and Citadel. And it was interesting that he lives out in California, where unfortunately, some of these fires, what's happened is terrible in Pacific Palisades and in the LA area. But was it, the point? My point was that when a fire was getting near his house down kind of south of LA, his insurance carrier, because he lived in a mansion, sent a water truck to his house, where they said the insurance company did the math of like, if this house burns down, we're losing a lot of money. So they actually sent a water truck out, parked it in it, and saved actually the whole neighborhood. And I think that's kind of how I've thought a little bit about how I've personally used KSPY, is more of, I've got these legacy positions. I don't want to incur cap gains. Because I hate paying taxes like everybody else. But I'm also worried about giving away potential gains because of some of this uncertainty, and those fears may or may not come to fruition. But for these newer allocations, I'm putting KSPY to work because I think it is that I'm embedding myself with a really good home insurance in John here, and that allows me to sleep at night because whichever way the wind turns, based on what your research is telling you, I'm prepared and I can get along. I can do my life. I don't have to be staring at my screen 24/7. I can leave that to John. So I know one of the questions we got, John, was around just the option overlay.
Yep.
And I know you've got a great. We touched on it, but slide 15, Eric, talks a little bit about how the overlay evolves, and kind of picture tells 1,000 words. But you can maybe speak to.
So obviously, like I said, the common strategy for kind of the all incumbent players is that within strategy, which is referred to as a put spread collar. Obviously, in our particular case, we're utilizing those risk range levels for determining the strike prices on those options, but writing a call at the sell risk range, writing a put at the buy risk range, and then buying a put at the last price of the S&P 500. In those, again, really unique and differentiated option strategies, which are the above and below risk range regime. Again, in the above risk range regime, we're basically expecting to see an immediate term pullback in the price of the S&P 500. As such, want to minimize our exposure and participation in market returns. So we're writing an at the money call and buying an at the money put, which basically gets the delta exposure of the portfolio down towards zero. On the flip side, again, in that below risk range regime, expecting to see an immediate term increase in the price of the S&P 500, but still want to have a level of hedging in the product. So we deploy a put spread, which is determined by the width of the risk range. So buying an at the money put and then selling a put down the width of the risk range with no call position. So obviously always long the S&P 500 in the underlying, and basically deploying those option strategies as that risk range regime changes, and then we don't hold options in the week that they expire, and that's obviously just based on work that I've done throughout my career, and even this year there's been some very public issues with other strategies holding options to expiration. So that's how the strategy works. And like I said, given the risk range duration of 3 weeks or less, we target options that are 3 weeks out in expiration. So.
Okay. Again, for those who are looking for today's presentation or our new white paper, please email us at info@KraneShares.com. Certainly great to reconnect Keith and John. And again, we're really proud about KSPY, what it's been able to do. And looking forward to further conversations.
Thanks.
Thank you.